Good afternoon and a welcome to everybody attending this seminar hosted by Brenthurst Wealth. My name is Magnus Heystek and I will be acting as your moderator for this panel discussion. I am told that we have almost 2,000 people registered for this webinar. Well, for us, that's the biggest we've handled so far. But fear not, a recording of the webinar will be downloaded on YouTube and will also be available as a link on our website. The topic today is very contentious and was sparked by two reports from two prominent economists and analysts who dared ask the question, can South Africa become a failed state within 10 years? The first report was penned by Claude Bessiac from a company called Unomics, and the report received widespread coverage, including Bloomberg, on the global news front. The report was also discussed on the Afrikaans radio station RSG, which featured two economists, Dawie Rood and Dr. Rudolf Botha, almost resorting to fistcuffs about the report by Claude Bessiac. Dr. Botha, who is well known as a sunshine economist, rubbished the report and made several disparaging claims about the authors, their research, and their credibility. Dawie Rood from the Efficient Group, on the other hand, tended to agree with the conclusions reached by Unomics and Claude. Our second speaker is Mike Shcussler from economist.co.za, an independent and often critical voice calling on government to change its economic policies as a matter of urgency. In a report published on the 21st of September on Network 24, Shcussler also warned that South Africa is heading towards failed status and said, amongst other things, that the SA GDP is now back to where it was in the 1970s. Government sector now makes up 32% of the economy versus 22% pre-COVID crisis. Government debt is to rise to almost 113% of GDP, according to Mike's calculations. Many government services and promises will be unaffordable in years to come. Tax revenues are collapsing, and South Africa cannot afford all these extravagant luxuries. The number of universities, for instance, will decline to 10 and maybe even 5 over a number of years. Most government hospitals will have enough staff, but not enough medical equipment and trained professionals. The South African Police Service and Defence Force will have to sharply reduce its numbers. And vanity projects, which cannot pay for themselves, such as the Gautrain and PRASA, will probably close, says Mike Shcussler. Our final panelist is well-known Magda Wierzycka, founder of the rapidly growing asset management company Signia, who has been at the forefront in the fight against state looting and corruption, taking a firm stand well before the rest of corporate South Africa woke up. Signia, for instance, was the first company to fire auditing firm KPMG as its auditors for its role in state capture. Magda, who has global business interests, including the recently launched Signia Oxford Innovation Fund, in which Brenthurst clients have participated very handsomely, has strong views on what needs to be done in order to make South Africa an investment decision of choice again. In recent years, for instance, foreign investors have fled the JSE. Almost 500 billion rand has been withdrawn by foreigners over the last 5 years, which is one of the reasons for the poor performance of the JSE and also the savings of many millions of ordinary investors. So with that, I hand you over to Claude Bessiac, who will be discussing his research methodology and findings for the next 20 to 25 minutes. That will be followed by Mike Shcussler, who has a unique way of interpreting the South African economic scenario, followed by Magda, who will wrap up her views, what needs to be done, and then we open the lines to our investors and interested people who can send their questions that we would like to answer in the time available to us. I'd just like to thank our three speakers for making themselves available at this point in time. The next 10 years can be make or break for South Africa. And with that, I hand you over to Claude. Claude, good afternoon.
Good afternoon. Can you hear me and see me?
Loud and clear, as they say.
Okay, wonderful. I would like to thank you for your very kind invitation. I am deeply grateful to you and your organization. As you know, the report we put out has been very controversial, made a lot of noise, and we have indeed been accused of being some unknown fly-by-nights. I think in the RSG right of response we gave, we addressed that. Just to reassure your audience, I have been doing economic growth strategy and corporate risk management strategy for about 25 years. I started my career as a special economic zone specialist with the World Bank. I've done about 45 special economic zone projects and policy reform projects across the world. And I have been working in South Africa and on South Africa for about 20 years now, looking for ways of improving the way we analyze the performance of emerging markets. So without further ado, I'm going to take you through a bit of my presentation, which I made, which summarizes the findings of our survey study, and hopefully opens up the field to some interesting questions and points. Can you please let me know, can you see the screen? Okay, I'm assuming that no answer is yes.
Yeah, we can see it, Claude. Thank you very much.
Okay, all right. So I will go through it quite rapidly and then perhaps leave it for questions. The usual legal thing, just to say that Unomics is not a financial service provider. We do not offer investment advice. And therefore, if you make investment decisions on our behalf, we absolutely reject any responsibility. And we might even sue you for your losses. That wouldn't be funny. This is a bit about us. Let me go through this quickly. So the South Africa's performance, the infamous Unomics report. So on 6 September, Daily Maverick published a summary in the essay form of an analysis we did, which really looked at South Africa's performance over the past 20 years or so, and was prompted by one of our clients, not to name them at the time, Impala Platinum, who in 2008, 2009 started wondering what had been missed by economists to account for the fact that we suddenly had this political power shift, we had the race riots, we had the electricity crisis, which kind of came out of nowhere and burst the bubble in an already difficult environment of the obviously global economic crisis. We decided to change the way countries are analyzed, to try to really find out what was happening in South Africa and why had the optimism that was prevalent at the time, well, proven to be deadly false. So our model demonstrates the following, and I'll come back to the model questions if there are some later, but I'm trying to keep the model conversation to the back end of what we're doing. But state performance in South Africa peaked in 2007 and has declined ever since. All 4 areas of state performance, and this is very much based on the model we've built of what is state performance and how you analyze it. So all areas of state performance, security, governance, prosperity, and social welfare have experienced decline or stagnation. As a result, South Africa has shifted from being a relatively capacious, capable, strong state in 2007 to being now what we call a fragile state in terms of its global ranking. But what's very interesting and very concerning is that it's one of the worst declines in fragility. And that its decline over the past 5 years have been similar to that of countries that are at war. So a mixed country that are not at South Africa is one of the worst world decline. Our methodology has allowed us to identify peer countries in South Africa's performance, and we've consistently analyzed South Africa's performance, and those countries are Brazil, Colombia, India, Jamaica, Mexico, the Philippines, and Thailand. And SA has been consistently the worst performer amongst these peers, of these peers for the past 10 years or so. On that basis, therefore, we say that if South Africa does not fundamentally change the strategy that has been adopted, its trajectory will continue to decline. And in terms of all key metrics of state performance, I repeat those: security, governance, prosperity, and welfare, South Africa will be a failed state. It will be moderately democratic, it will be uncompetitive, it will be extremely violent, or remain extremely violent, and have social welfare levels that are amongst the worst in the world. As a result of that, it will transition from being a fragile state to a failed state. What we're saying is that it's not jumping into failure immediately. We don't have 10 years, and I hear a lot of people misinterpreting what we say by saying, well, we have 10 years to fix things. No, we don't. We have to fix them now, in the next year, 2 or 3 years. Otherwise, we will be a failed state. Why are we pessimistic where others have been systematically optimistic? The question is really, and this is where we started our inquiry, our model 10 years ago, is, why do economic forecasts fail, and particularly in countries like South Africa? Well, firstly, there are political and economic interests, which push for a certain way of viewing reality. There are cognitive biases, psychological and obviously emotional, and then there's data and methodological problems, and they often combine. In the case of SA, key issue has been groupthink around the Rainbow Nation and the imperative, the obligation of optimism. And then really, I think, deeply an inability to truly understand what makes South Africa work and not work, what makes it what it is. And the persistent belief that the country is an emerging market with a functioning business cycle. I call that the S delusion in the BRICS myth. Since 2000 and before the Reserve Bank, 1 year, 2 year, 3 year forecasts have been wrong by order of magnitude on growth forecasts. And that highlights the danger of this kind of forecast in this kind of places. The red line is the actual growth of the GDP. The dark green line is the 1 year forecast. The lighter green line is the 2 year forecast. Then the kind of lighter green is the 3 year forecast. The magnitude of failure in forecasting South Africa's growth over the past 10, 20 years is absolutely astounding. I mean, the margin of error in terms of 1 year forecast for the period 2010 to 2019 is 5%. Cumulative, not on average per annum. And for 2 years, it's 13.1. Treasury systematically underestimated growth in the 2000s and has overestimated growth since then, to the point of disbelief. And when you look at what they are forecasting in terms of the post-COVID recovery, and they're simply making the assumption that we're going to see the same kind of reversal to the mean that we saw after 2008, 2009. I think they are dead wrong for a number of reasons we can discuss. But what's really interesting is that you see the red line, which is the actual growth, and then you see the blue lines, which are the running 2 year forecast. And I mean, it's reversal to the mean, right? And that methodology clearly has failed South Africa and investors in South Africa. So Why is SA failing? That is the fundamental questions, and I have yet to have heard any coherent, global, holistic, theoretically valid approach, because everybody has their nose on the driving wheel and they're trying to make it to the next 2 to 3 years. And very few analysts have, in my view, the discipline, the patience to build an analytic framework and the incentive to look at the very long term, backwards and forwards. So, you know, we have done a lot of work, and the two main conclusions we reach is that number one is that the fundamental socioeconomic structure of apartheid hasn't been addressed. And it hasn't been addressed because the depth of it has been underestimated, and because the strategy that has been displayed since democratization has been the wrong one. The endemic violence, the structure of the political system, the structure of the economic society, and spatial apartheid have really not been fundamentally altered. Only the political system and distribution of power have changed, but not to the right effect. So you effectively have political democracy, but you don't have economic democracy. And now that sounds very much like what EFF would say. Yes, it's true. And it's very dangerous to be there, because it actually feeds the kind of populism that the country is likely to continue experiencing, and which represents the greatest threat to the country and to the Ramaphosa presidency. So,
Claude, can I interrupt for a second? Could you just speak a little bit closer to the microphone, if you don't mind?
No, I don't mind at all. Is that better now?
That is much better. Thank you very much, Claude. Thank
I
you
usually
for that.
have my headphones, but you know, I'm using my laptop and it's not quite doing what it's supposed to.
That is perfect.
Okay. So my apologies for that. So in essence, what we have is we have a fundamental failure of strategy. And the economic decline, the social decline, the political decline that we are experiencing, and the environmental decline that we're experiencing is a result of that failed strategy. And what does that strategy rest on? It has rested on the notion that the country is a resource-rich country, and that these resources, combined with the capital-intensive industrialization strategy, will lead economic development, kind of semi-open, semi-endogenous growth model. But it has excluded the workforce, the population, out of production. And because of that, we have a situation where simply the sources of growth are simply insufficient to create significant growth, to alleviate employment, to resolve poverty and inequality. And that's in the best of time. I mean, if you look at the performance of the economy under Mbeki, yes, it was impressive, but it didn't last, and it certainly did not achieve the kind of political buy-in to the kind of economic strategy that the country needed. So in our times, that solution, that approach can only make things worse. Now, the first myth about South Africa is on this graph. The myth that we are a resource-rich country. Now, I'm not going to bore you with all of this, and it's available on our report, which you can either get in a summary version on the Daily Maverick website, which you can download from our website, the full version. But what this shows is that countries that choose to depend on natural resources for their growth need to have natural resources that represent, where natural resources represent 15 to 20 to 30% of GDP. We are nowhere. We are about 5%. So we're very similar to countries like Mexico, Brazil, and Colombia, countries that have a bit of natural resources, but have a skewed entirely labor-intensive industrialization. And it shows us as trailing in terms of growth The peer countries of South Africa, which are highlighted in green there, Philippines, India, Thailand, which are countries that don't have natural resources and only have their labor forces as a potential way out of poverty. And it shows that their growth is significantly higher than ours. So, you know, evidence one is failed strategy choice in terms of resources. And obviously, the pendant of that is this absolutely catastrophic situation in terms of employment, wages in GDP, GDP per person employed, and GDP per capita. So we have of our peer countries, we have the lowest employment rate in the population. And now that the country has lost 2 million people, it's going to be around 15% of the population being employed. Now, in a country where we only have 5% resource rents, having only 5% resource rent and 50% of your population, 15 employed, is a recipe for economic collapse and political disaster. And this is where we are. Yet, we have a fairly high level of GDP created per person employed because we have this dual economy. So few people are employed and they produce most of our GDP. But they are over-indebted and they are overtaxed. And so they are disincentivized to invest and work. Our wage bill is actually very high, and it is the highest amongst peers. So wages in GDP are very, very significant. So this is the really screwed up situation. We don't have natural resources enough. We have massive amount of unemployed people that we are not putting to work. Our labor force that is employed costs us a fortune. And its productivity is quite high, but it is stagnant and in fact decreasing. So that leads us to the conclusion that the economy is hollow. It suffers from very low savings, very low productive domestic and foreign investments, very low and declining exports, and rising and unsustainable debt. On top of that, we have this weird divorce between macroeconomic policy, which is in the hand of the center right of the ANC, and microeconomic policy, which is where jobs are created and growth is created, which is in the hand of the left of the ANC and the labor unions, which have kind of a veto on anything affecting microeconomic policy. And so this ensures that we have low growth and socioeconomic decline. And, you know, giving macroeconomic policy the task of maintaining, stabilizing growth is absolutely fine. All it can do is manage decline. And this separation is purely a political contraption to try to reconcile irreconcilable factions. So in terms of comparison with our peer, this is kind of a new way of graphically representing economic structures that I've been playing with, and I think it's quite meaningful. You know, I call it the geography of economic hollowing, South African canyons and Indian valleys. What this shows is that, you know, of all our peers, South Africa has had the lowest growth since 2010, with GDP per capita declining. We are now 135th in the world. Highest per capita social expenses, with social transfers representing by itself 60% of government expenditures. But we still have the worst educational outcomes. We have one of the worst health outcomes. We have the worst unemployment, worst youth unemployment, and the world's worst inequality. So government is spending a tremendous amount of money on social capital, but it's failing to generate it. We have the second lowest savings in GDP, investment, and FDI. We are the worst decliner in the share of industry and manufacturing in GDP and in exports of our peer country group. Highest in consumption in GDP, highest in government expenditure in GDP, and rising. And we therefore have the lowest ratio of unit of GDP per unit of government expenditures, and it's falling by 10%, which means that, and you could almost conclude that there's actually an inverse causal relationship, where you still hear the ANC talking about the fact that we need to continuously activate the expenditure multiplier, you know, we actually have a reverse causal where the more government spends, the less growth we have, and the more debt we have, and the lower the social outcome. And that are the traits of a failed state. If you look at the kind of geographic landscape, what you see is that indeed very high consumption compared to our peers, very high government expenditures compared to our peers, not particularly high resource rents, and very, very low production. So this is a fundamental economic structure problem posed by fundamental policy choices problems. This is an interesting little graph because what it shows is that it compares our relative position, so India is the point of reference here, in terms of the impact, in terms of the relationship between government expenditure, GDP, and the GDP expenditure ratio. And what it shows is that the efficacy of government expenditure in India has significantly grown over the past 20 years. Whereas that of South Africa has actually not expanded at all, but is as small as it is small. So we spend more and more money achieving less and less growth. And yet what concerns me about this is, and this is the last slide, what really concerns me about this is that, and I'll talk to you about now, is so we have the model has failed. Everybody recognizes that the model has failed, but no one is diagnosing it right, still in the model, which leads, you know, big business organizations and government getting together again and again and again, rehashing the same old strategy that we need to invest massively in infrastructure. And yes, some infrastructure needs investment, particularly fixing ESCO and particularly fixing, you know, key capacities. But when you have very low capital utilization, when you have very low labor utilization, where you have very low economic activity, where all your key sectors are under pressure, the chance is that you're going to be spending on infrastructure that has negative returns. So, you know, the rejection of labor-intensive export orientation as a cornerstone of development has been the foundational mistake of democratic South Africa. And in doing so, the ANC has reproduced the ills of apartheid. And it has crystallized the poisonous divorce between economics and politics. And this divorce, in fact, has incentivized the political elite that we currently have against adopting a sustainable development strategy. You know, I'm being very, very cynical here, but I received a couple emails from a couple academics at Cambridge University and elsewhere, telling me that I'm onto something here. That, you know, it looks like we have potentially reached a point where we have an anti-developmental elite, and that the strategy can only change when the structure of incentives of the elite is changed, or that elite has been replaced. And that's typical of fragile states and failed states, is that there is a complete disconnection between performance of the economy and the performance of the political system. And we shouldn't be surprised, because if I go back quickly to this graph, which is kind of charting the path of South Africa. Sorry, guys. What you see here is that the left-hand graph shows South Africa's ranking in prosperity and democracy, and it has been losing rank, but it's still a fairly democratic, fairly competitive country. And if you look at the right-hand side graph, what you see is that the performance of South Africa on security and social welfare. So it is like an emerging economy, although one losing ranks in terms of governance and economy, but it is very much a third world country in terms of security and social welfare. And the right strategy would have been to leverage the performing side of the country to pull the non-performing side But in fact, what we're seeing is the opposite happening. And the reason why this is happening is precisely because we have undermined the creation of social capital through mass employment. And that's for mainly ideological and political reasons. So we need to absolutely change that, otherwise we do end up being a failed state. And once you're a failed state, you're stuck there because you've destroyed so much social capital, you've destroyed so much infrastructure capital, you've destroyed so much capacity in government, you have chased away investment, that you are really, at the bottom of the global scale, the global food chain. So to finish my presentation, I want to go back now to where did this analysis come from? So I mentioned briefly that the aha moment for me was the correlation between Mbeki's loss of power, his inability to place his successors, and at a time when the economy was performing the best it had in about 20, 30 years. And that showed me that there was a fundamental problem with the connection between economy and policy and politics. And I say, South Africa is stuck in a deadly political economy trap. And if Mbeki couldn't do it, while the world economy was growing, and while the country, benefited from relatively fast growth, then what is the chance that Ramaphosa is going to do it, knowing that he only has 50% of the NEC on his side, that there is a tremendous populist pressure, that there are enormous amount of calls for the kind of quantitative easing pushed by supposedly new modern monetary theory, and that these guys simply want to do away with any remainder, any remnant of fiscal and budgetary discipline, and just print money, because supposedly the problem is a problem of demand. We know it's not a demand problem, it's a cost of production problem, it's a competitiveness problem. But the siren songs of populism and of the continuous steps of accelerated selections of policies that fail and fail and fail continues. And this is what is absolutely alarming for me. Now, this doesn't mean that there is no option. There have been many other countries in the past who have found themselves in situations that are much worse than South Africa. Japan after World War II, South Korea after the Korean War, Taiwan after the separation from China. Nowadays, a number of countries have gone through tremendous difficulties. Obviously, Magda, Eastern and Central Europe, after the end of communism, and went through very, very painful changes to their political, economic, social systems. How do we reconcile the divorce, the separation chasm between politics and economics? This is called the dual track, and it's what many countries have adopted. It's to say, well, we can't really reform the economy because there are too many vested interests against it, in business, in labor, in government. But we have to do it, otherwise we're going to have collapse. And we need to employ our people. So the idea is that you give yourself 10, 20 years to progressively, to rapidly stabilize things first, and to make grand bargains, but not the kind of grand bargains we are used to talk about in South Africa, which is everybody gets under the same roof at Nedlac, and they come up with an animal which is neither horse nor cow, and is simply non-functioning. But where a government governs, and the government says, right, so we are not going to cut public expenditure and public sector employment now because we need to sustain consumption, but we are going to liberalize parts of the economy. We're going to put that in the SEZs, and the SEZs will be focused on labor-intensive industries for the world markets, for the African market, as the African market And that allows us to take benefit of the relocalizations of a post-COVID world, where supply chain lines must be shorter. So we're going to open South Africa for business massively. And you, Labour, you may not like it, but that's the deal. And yes, you may go on strike, but you're going to have to choose at some point whether you are fighting for your members who are condemned to disappear, as Mike's report said, because hospital will end up having to cut employment, and schools will have to be closed in time, and the public sector will have to be diminished, and there will be no labor pension left if we continue like this. So it's government governing, and it's government seeing the absolute fundamental necessity of making a long-term strategic change, and not making compromises through dialogue, but making compromises through careful manipulation and balancing of vested interest.
Well, thank you very much. We have to end it there. We only have 19 minutes, but please stay on. We're going to be taking Mike Shcussler now, and then Magda, and then we got lots of questions coming through already. Thank you very much for that, Claude. We'll speak to you later. Mike, over to you.
Okay. Thank you very, very much. I hope you all can see my screen. And I'm about to go on. If you think you can see my screen, I'm going to hopefully entertain you enough, because I think we all want to know what's ahead of us a bit. And I'm going to sort of take it between where Claude was and where the investment people are going to come in. So I'm quickly going to look at the world economy, the South African economy, our government, which Claude spoke a lot about. If we take a look at the world economy right now, the forecasts are averaging around a 5% decline, and then for next year around a 4% increase. You can see there's a range of forecasts. There's a lot of uncertainty still, and it says to me that the world is not a happy place right now, very simply put. And on the right-hand side, you can see that the GDP per capita is going to take approximately 4 years to come back for the world, because the world population still grows, whilst it takes about 3 years for the actual GDP to reach or surpass the numbers.
What will they do?
Okay, I'm going to try sharing my...
Mike, we can't. All right, there you started your sharing. Thank you.
Okay, sorry. As you can see here,
Mike, I think you've just put your whole email correspondence on the air.
Okay. Just hang on. Can you guys see the screen still?
No, we can keep on trying.
Okay, I'm gonna new share. How's that?
There we go. Thank you very much. Wonderful.
Okay.
Wonderful.
All right. As I said, it's about a 5% decline this year, and next year it's a 4% increase. Then we go back to more normal times. As you see, it's a range of forecasts, anywhere between a 4.5% decline this year to 6% from the OECD. So, and next year we see a large scattering of forecasts as well. UN Economics is only 1.5% increase, and the IMF is hoping for, and Oxford Economics for a 5.8% increase. So if I look at that average that I put down at the bottom there, this is the result is on the right-hand side, and we are then going to see the world's GDP still below 2019 levels for a period of about 3 years, and the GDP per capita for about 4 years. If you look at the individual countries, you can see South Africa will be one of those quite harshly affected with an 8% decline. This is from the Economist magazine's poll of forecasters. And you can see right on top there, Egypt and China are still expected to grow, whereas Peru is going to decline with about 13%. They've obviously had the longest lockdown by far now. If we look at the things like air freight, you can see it's very heavily impacted. So whilst air freight is only about 1 or 2% of the volume of world trade, it makes up about 33% or a third of its value. The container throughput is literally about 50% of the volume, but it's about 60% of the world trade, or slightly less, about 55, because there's bulk commodities as well, and that's also still quite negative. And so you can see it's going to take a while for the world economy to get back. If we look at the manufacturing sector, South Africa came in third last, or we had the third largest decline, if we look at it quarter on quarter, whereas Taiwan and China obviously in a very different thing, they caught the virus early, if you wish, and therefore they showed an increase. Taiwan didn't lock down, and then you can see virtually by the severity of the lockdown is how manufacturing has declined around the world. These are all from official statistical agencies. Right now, however, people think that we're going to bounce back. The PMIs are all, or most of them are looking quite positive, but we've got to remember they come from a low base. So when they ask the guy the question, how's your outlook from where you stand now, then typically the purchase manager will say, well, we're going to do better. And strangely, South Africa's manufacturers are at the moment about in third place of all these countries. So it's a very big bounce back, but it won't make up for all the losses that we've had. There's no doubt in my mind about that. One can just look at the GDP on second quarter. You can see China and Vietnam are still up, virtually zero for Thailand. And then you see the Spains and the South Africa and the United Kingdom, and they all show quite large declines. And the problem for South Africa is that we've already started declining before, which is another factor to take into account, because you can see in the first quarter we had a decline already. But you can see here as well that China also had a significant decline, but nowhere close to what most other countries got. Commodities have held up better than I thought, and copper has now come down a bit, but Dr. Copper's got a PhD in economics, and it says to me maybe our optimism of the V-shape and the full recovery is maybe a bit overdone. Oil prices are struggling around the $40 mark, and I don't think that's going to change much. I think what you all want to know is about the South African economy, and as Magnus said, I wrote an article about it. And if you take a look here, this is just the quarterly domestic product per capita, and you can see that significant fall. Now that takes us back to roughly early 2000s, 2002, 2003 GDP per capita. But it also says to me that we were far richer in the 70s and 80s, and in fact even in the early 90s, partly than we are now. So this is a very big decline, we all know that. But the decline in GDP per capita is huge. You can see here, I don't want to go into all the details, but cars, retail, all those sort of aspects also took heavy declines. I think the furniture and appliances increase in the 3 years ago more to do with TVs, everybody was watching Netflix, than it had to do with anything on the economic side, if you wish. This is where I'd like to just stand still for a little while. If you take the non-financial private economy, so that is manufacturing, mining, trade, transport, communications, construction, agriculture, and the like, that used to make up around 74–75% of our economy. It's slowly been declining, and that's what Claude has been referring to in a way. And the state has become bigger and bigger and bigger. And the state relies on this, and so does the banks, because the banks can't lend to themselves. They can only lend to productive, at the end of the day, parts of the economy, or to government that then taxes the productive part. And you can see that this has been a significant fall to where the state now all of a sudden, after, because they didn't decline on a year-on-year basis, they're still up 0.6%, yet the private economy declined 25%. So the non-financial private economy has got such a burden on it that it's unbelievable for this sector to dig itself out of this hole. If you've got a 25% decline, it also means you need to increase with 33 or a third percent to come back to the level you were at before. So for the non-financial private sector, the increase that it's going to have to put through is going to be much, much bigger. And when the government is going to be there and tax this part of the economy to sustain itself and its spending, it's going to cause a huge problem. And this sector is going to struggle the most to get that. I think we're over the worst, there's no doubt in my mind. We are going to see a good third quarter, probably the best quarter that we've ever seen in a long time, but it doesn't come back fully. Let me give you another example. If you have 100 Rand and I take 50% away, then you've got 50 Rand. If I say, well, I'll increase with 50%, then you're only at 75%. So you're still 25% loss, if you wish. And that's what's going to happen here. We're going to have a major comeback, probably in the region of about 8% or 9%, with, in other words, season adjustment annualized around the 35–40% mark in the third quarter. But after that, it's going to get a lot slower. And that says to me that we're still going to be about 12 to 15% below where we were before. The one thing that South African business has is that it had a positive cash flow going into this crisis. So I think South Africa Incorporated could survive this because of the cash flow. So if they take away depreciation and investment into other companies and selling other companies, they probably went negative with the cash flow, but with state help of loans and also paying their employees, TERS, there's 45 billion paid there. Another 50 billion was pumped in via the Social Security, another 6 billion via the injury on duty type stuff, another 2 or 3 billion from the private sector. So ultimately what and then the lower interest rates obviously as well, but you had virtually 100 billion pumped into this. And still, I think there will be losses, but because the private sector and the corporate sector as such in South Africa had about 20% of their turnover in savings, they were able to survive this. But now coming back, it's going to be a very long road. And that's the problem. And the other problem is that business doesn't believe that government is going to solve this. They haven't believed that for a long time. And you can see that businesses believe for more than 10 years now, the majority of businesses, that the political constraint in South Africa is a major problem for the economy. And that business confidence, or that drags business confidence down. And then that also, on top of that, the business confidence drags growth down. So government is going to have to shape up, or it's going to find out that business is just deserting. Businesses never announce leaving. They'll announce coming. They'll say, I'm building a new hotel. But when they go, they don't say anything. And that's what we must realize. Money is silent, very silent when it goes. The South African government does not have much room. Claude was alluding to this, so I'll quickly go I'll show you some graphs. Our government expenditure just doesn't stop versus other emerging markets. You can see in 2004, we were on the lower side of government expenditure in emerging markets. Now we're very much on our own out front at 35% of GDP in 2019. That's very big, and that says to me it's just too big. If you go and have a look at the expected and received tax revenue, they expected a 5.2% increase in February for the whole year. I just drew that blue line there. You can see that this is now around 20% negative. So it's a decline of 20%. So the difference is 25% of what they expected. The central government balance is really bad. We're now in a situation where on a 3-month basis, every month our shortfall between expenditure and revenue is 60 billion, and it's going to get worse as we go along. And that is one of the reasons they haven't paid the salary increment to government employees yet, because it would look another few billion worse. But at 8% of GDP and declining very quickly, you can see it's a huge problem. Our debt to GDP versus other emerging markets is much higher. These are old numbers. They only go to the first quarter of this year, but already then we were 65% according to the Bank of International Settlements. The graph here that looks a bit busy, the point is this is a government graph. So when Magnus said, I said, we're going over 100 and then we're going to 130% of GDP. This is government figures are saying if they have a passive scenario, if they don't do anything, we are going that way. And so far, actually government figures have underplayed the GDP forecast, or the debt to GDP forecast. And at this moment in time, it looks like we're going to end up this year at 83 to 84% debt to GDP, not the 81 point something percent that they've put here. So quite frankly, this is a crisis waiting to happen. Just pointing out something, once a country goes over 130%, any country, developed or emerging, debt to GDP, only one, and that is Japan has survived that. Belgium survived it because they joined the euro, they brought down their interest rates. But generally, out of 50 odd countries, only one, and that is Japan, has survived it on its own, and not by joining someone else without a financial crisis. You can go and look at the Argentinas, the Brazils, the Greeks. All those are major problems. And we are a small economy, and if we go over that mark, and I think our mark is probably a lot below that, it's going to become a huge problem. And bringing down that active scenario is going to be very painful, and I don't know if it's politically feasible. So in this whole thing, where would I think we could invest? Well, the first thing is, as Magnus has been saying a long time, if you go and look at the South African market versus the emerging market, we haven't done well. If you look at our gross domestic product, it's giving us a clear indication that the JSE is likely to give us further negative returns in the next while. Remember something like banking, you're not getting the profits of now, you're getting the profits of yesteryear from when companies could pay. If you get to a situation where companies cannot pay or something, then the financial indicator of the banks will not look very healthy, just as an example. The other factor is just the MSC world total return, in other words, net total return, and the one for South Africa here is, I think, also net. But the only difference is that there's a taxation on the dividends in this, on both sides. And you can see that if you invested in 2010, you would have done much, much better in the world index than in South Africa. And the slide next to this is actually, it doesn't show the whole picture, sorry about that, but we were at our best 1.5% of the world's stock markets. And that's not all of them. I've left out some small ones like Botswana and Australia. The market cap from the World Federation of Exchanges and now we're 0.9%. More realistically, we're probably 0.75%. So if you invest in South Africa, you're investing in less than 1% of the investable product of the world. If we look at the world indices just from the start of this year, you can see in South African Rand terms, we've declined, that's up to yesterday, with 6%. But yes, other stocks like Euro stock market has declined even more. But if we look at it in dollar terms, then the fall for South Africa, whilst it is in a similar fifth worst position, you can see the fall has been much more. And ultimately, you know, you would have even made money just putting your money in the euro and not having an interest rate there. So it's a very strange thing. I don't advocate Bitcoin. It's just something to look. And then you can see gold and China doing quite well. And strangely enough, in the last while, copper, I'm not quite sure what to make of that right now, the whole commodity thing outside the precious commodities. I've done 4 different periods of investment returns from May 1994, that's the whole history of South Africa. Your best returns would have been investing in the world stock market, the MSCI, followed by gold. Eskom bonds feature quite prominently. Consumer inflation over the whole time period doesn't look too bad. Electricity prices, however, beat the bank rate. If I go to 2000, yes, the world didn't do as well, and the gold price and the JSE were the top 2 performers, but that depends a little bit on when you invest. When you had a bubble in NASDAQ at that moment in time. If you go back to 2010 and 2015, you can see again the world index, the MSCI, and I'm not using a single country, I like using the whole thing just to give you an outside view. And I don't do companies, but I'm just saying you would have done a lot better over any of that time in the world. The interesting thing is that's also the only thing that beat electricity price increases in South Africa. I mean, it's incredible how our electricity and our water have been increasing, and they've beaten the JSE, they've beaten our government bonds, they've beaten our inflation rates. Our nominal policy rates are a little bit low at the moment, but it's still not the lowest in the world, and I think there is still a case to be made in uncertain times for a little bit of money in the short-term cash market or the shorter end of the bond market. You can see South African bond returns are or yields are very, very high, which reflects risk. So the one graph here is very simply put our bond premium over emerging markets. The federal fund rate, when it goes negative, the real one, it's always good for gold. So that's just an idea. But, and this is the big but, gold is an insurance policy. It is not an investment instrument in normal times. It's always good to have a little bit of gold, but maybe you do it in the gold mines, maybe you do it in the commodity itself, but don't go too wild on gold either. It's just, we go mad in South Africa on gold sometimes. I'm going to leave that out. My big thing here, and I'm nearly finished, is if you look at the Rand, yes, there are times when the Rand comes back. So when the Rand hits 20, you should have already been out of the Rand. But if you're still not out of the Rand, then you can wait a month or 2 and you will have another opportunity to take your money out at 18 or 17 or 16. And maybe that's the one thing that you should follow. You shouldn't panic the day when the Rand is at 20 or 25 or 30, wherever it goes to. So what you need to see is a long-term movement here. This is 1970 would equal 100 in both cases. So you can see we've got less than 5 cents left of our Rand in dollar terms that it was in 1970. So this is a long-term thing. I think next year, Stephen Roach said that the dollar will have a bit of a fall, but this is why I'm using a broader exchange rate. So I'm looking at the euro, the dollar, the yen, the Chinese yuan, and etc. And I really think that we're looking at a situation where the rand just continues to fall. There will be months in between when it rises. But a strategy maybe is to take your things out in 3 stages, 6 months, 6 months, 6 months, if you're not sure if you should do it now. That's just one thing. Some quick forecasts. I know Claude is always going to say this is wrong from the Reserve Bank, but you can see the decline they've got penciled in now is 8.2%. The private sector is at 8.4%. I personally am at 9%. But next year, there's not that much of a bounce back. The private sector thinks it's 3.4%. The Reserve Bank thinks it's closer to 4%. We'll see what Treasury says now with the medium-term budget, but nobody's saying that the lights are going to be shot out. So we're looking at 4 to 6 years before we reach 2019 levels for GDP, and probably longer than a decade before we come back in GDP per capita terms where we were in 2019, and probably about 15 years before we get to 2014. One positive part is the worst is behind us. It's not a straight line up, but the worst is behind us. The first part of the bounce, which is probably mainly behind us now too, is strong. There's no doubt about it. As I said, it's 4 to 6 years for recovery, far longer for GDP. These are just my forecasts. I've given them to you. Oh, the one thing is the SA deficit is no longer going to be 14% of GDP or 14.6, which Mr. Mbweni said. I think it's going to be 16% or more. I'm now hearing from some of my colleagues that they're looking at 17.5% debt to the deficit of GDP. So government deficit. Inflation, I don't think is going to be a major problem, but we, without water and lights, just one interesting thing, our inflation goes down with 1.1%. Without some taxes increases, another 0.3%. So virtually 1%, 1.5% lower inflation right through. So we would have had, for example, last year, a 2.7% inflation rate, not a 4.2% inflation rate. I think so far we've fared quite well with the weakening rand in the inflation scenario, but certain things are going to get more difficult. Last slide, the comeback has started. It's going to take a while. The other thing I'd like to make a point in is sometimes the best investment decision is just making sure you do not lose money. That might be diversification, that might be anything, and that's from the great Benjamin Graham. And what I mean with that is, in South Africa at the moment, if you've got an inflation rate of 3% and you can get 3.5% in the bank, then that's okay. And maybe you just want to also hedge your bets, because the fact of the matter is inflation will go up quicker than the bank rate will be, but you might want to be in the short end of the bond market. But also, very important, you may want to certainly take a large part of your money into equities in other markets. I think the American market's overpriced, but I think there are other areas to look at there. And I think that's it from me. I'll give it back to Magnus.
That's great, Mike. Thank you very much. Straight from the horse's mouth. That's Mike Shcussler. You're going to end up with Magda Wierzycka, who's the MD or joint MD of Signia Asset Management. And Magda will also be talking about some of the very innovative international investment products that they have on their platform, which we have been using as a company very, very successfully. And so, Magda, thank you very much. I believe you're still in London. Is that correct?
Indeed, indeed. But I was in lockdown for months in South Africa till August, so it's only the last few weeks.
Okay, you swam back to London. Anyway, glad to hear you, Magda. Take it away.
Okay, well, thank you everyone for obviously joining this webinar. Thank you for inviting me to speak. I carry, I think, a very heavy burden on my shoulders of trying to lift everyone's mood after what we have just heard. And let me preface it with a few comments around, how I see the situation in South Africa. And then, I can obviously touch on the products and investment strategies that I think are appropriate going forward. But, we need to recognize that in South Africa, we are living in a society which is regarded as the most unequal society in the world. And I'll just give you like one data point, and that is that our 50th percentile monthly salary stands at 3,600 Rand. So I would guess that almost everyone on this call is somewhere in the 1 to 2% bracket as far as wealth distribution is concerned. So think about the rest of South Africa and where they are at, apart from some very, very wealthy oligarchs. Now, when we were in trouble as a country before the lockdown happened, when Cyril Ramaphosa stood up in March and said, we're going into lockdown, and everyone cheered, I, the very next day, found Wim Trengove, SC, who is the most eminent constitutional lawyer in South Africa. And I said, I'm suing. I want to sue Wim. I want to sue the government for infringement of my basic constitutional rights, but more importantly, for the damage that this lockdown situation is going to cause in what is already a very, very fragile economy. And, I listed all the factors that are so transparent to us now, from, poverty, unemployment, crime, social unrest, and everything else associated with this lockdown. And Wim said to me, Magda, you are going to waste your money because government is going to put dead bodies on the table. So you are going to make this very complex macroeconomic argument for why lockdown is not the right strategy for South Africa, including the fact that, I didn't believe that any level of social distancing could be maintained in townships. I believed that South Africa was going to follow Sweden, whether we liked it or not, that only the middle classes and a very small percentage of middle class were in lockdown. He said to me, I will lose. So the top constitutional, silk in South Africa told me I will lose and I will waste my money taking on government. So where are we a few months down the road? Well, we are in a worse position, much more, problematic position than ever before, as is the rest of the world. And what that means in practice is that we are on our own. So every single country in the world is going to be grappling with their own issues of trying to increase taxes, the wealthy trying to escape the tax nets, unemployment, massive unemployment, social benefits, payments increasing. Everyone, huge focus on healthcare. So everyone is in the same boat. And I don't believe that anyone is coming to our aid. So if you then look at South Africa, where we're heading for this kind of over 8% contraction into 2020, increasing debt levels, over 2 million jobs to be lost this year alone, if they haven't been lost already. What can we do to prevent South Africa becoming a failed state? And I do believe that it's possible. Whether it's probable is another thing. So one thing that we need to recognize, and all of us on this call, is that we bear collective responsibility for what happens to South Africa. If you look at ANC and our government, we already have, everyone talks about coalition government in few decades to come. We already are being ruled by a coalition government. So you've got ANC, which is divided into the right, and the people who are trying to do good things for South Africa, and then the corrupt ANC. So effectively, you have a coalition government running the country, which is why we are in this completely indecisive, paralyzed situation. And yet, as society, and here I talk about, so broader society as well as the business sector in particular, we're looking at government, pointing fingers at government, saying government this, government that, government must do this, government must do that. Well, government isn't going to do anything. We actually, what we would need for government to become effective is decisive political leadership. And we are not seeing that. We haven't seen it under Cyril Ramaphosa. I know we all had very kind of optimistic views of what he can bring to the party. Unfortunately, I don't think he's a decisive leader. I think, as I said, fractured government. So what are the solutions? Well, some solutions are, it has to get darker before it gets lighter. So one is, we're seeing people in the streets today. social unrest. You know, we need to, again, take to the streets as we did in the state capture era. But more importantly, we need business to start being vocal. So again, you know, I feel like I'm speaking through my state capture days, 2017, where business is silent, literally silent. Despite everything that's happening, business is not talking. And right now we should have, you know, a group of 20 most influential business leaders in South Africa literally forcing their way into government and putting demands on the table, not negotiating, demands. You know, I cannot believe that society as a whole, not only in South Africa, but collectively, we are sheep. Look what happened in lockdowns. Governments worldwide introduced lockdown measures such as curfews, restricting you from seeing your family, restricting you from visiting restaurants, never mind cigarettes and not drinking alcohol. And we complied like sheep. Who made me a sheep? I lived through communism. I'm not a sheep. And I don't believe that anyone has given any governments the right to treat me as one and to put me in a virtual prison. So we need that period of darkness, of almost internal infighting, after which we need a private-public sector collaboration. And we do need some kind of a social compact, which is for real, not the nonsense that's going on in South Africa at the moment. You know, so what are the solutions that I would put on the table? Well, first of all, to prevent South Africa becoming a failed state. Because, you know, if we continue on this trajectory, I think, you know, this trajectory is clear. I don't think that there is anything on the table at the moment that can stop this gradual deterioration of our economy and conditions in South Africa. So, you know, what I would do is I would put a think tank together of the 20 smartest people that you can find in South Africa to come up with policies which can be implemented relatively quickly. And some of them can be short-term, some of them can be long-term. And this is the structural reform that you're talking about. You know, structural reform is wonderful verbiage. I love it. I love jargon, particularly in macroeconomics, which is littered with it. You know, we need practical policies and practical steps to be put on the table right now to stop this decline. So what are the obvious ones? You know, on the short-term side, massive budgetary reallocation away from failed state-owned enterprises towards the ones we need, whether they failed or not. We need electricity and we need water. We need transport to thrive. Everything else is arbitrary. And transport, I do not mean SAA. We need, you know, in order for those enterprises to have any hope of a recovery, we need to start looking at privatization, or at least part privatization of state-owned enterprises and involvement of the private sector in the running of those state-owned enterprises. We need to dedicate our resources, whatever resources we have, to the provision of those basic services. So the electricity, water, transport in terms of infrastructure. Any other project can wait. It's irrelevant. You know, we need to start looking at strategies, mass strategies for employment. Now, you know, short-term infrastructure, yes, but we don't have any tangible infrastructure projects on the table. We need 2 or 3. You know, if you actually think about the fact that what's driving economic growth in South Africa is, you know, are not mass creators of employment. It's financial services, it's trade, wholesale retail trade, it's transport and construction to some extent. You know, the big employers, the mining, the manufacturing have been in decline as sectors for over a decade now. And then we need to start looking at long-term trends. And the long-term trend, you know, let's group it under this 4th industrial revolution label. We need to invest in basic education. You know, I cannot believe that let's park apartheid and apartheid policies. But in 1994, there was this amazing opportunity to turn South Africa around by investing in basic education. Instead of doing that, we destroyed basic education. But having said that, again, not all is lost. You know, given the ability of technology to reach the masses, The fact that you could make data availability cheap, that you could equip every child in South Africa with a cheap plastic laptop and a classroom made out of a container, and a teacher who sits in Johannesburg teaching thousands or reaching thousands using technology. Not all is lost. You know, and if we don't implement some of this right now, and if we don't start coming up with some of these policies right now, then yes, we are a failed state in a decade, or we in the arms of IMF, which is equivalent to being a failed state, because IMF is not a solution to anything, and you only need to look at Greece as an example to know that that is not the solution. So, you know, there is hope. But the problem is that, you know, unless business leaders, community leaders, trade unions for that matter, take on the government and start becoming not the ones who are pointing fingers, but being part of this conversation in a forceful manner, then yes, indeed, we are heading down a very, very grim trajectory. So, you know, okay, so let me park that. And, you know, that was my little contribution to how can we look at things from a positive viewpoint as opposed to just economic negativity, and then talk to, you know, what I do believe about investments and savings. And, you know, I was in a previous webinar session, which was a financial services conference, and someone said to me, how is your money invested at the moment? And do I have any money invested in South African equities? And I said, absolutely zero. So what do I believe? You know, I do believe that we have massive dislocation, and that dislocation happened after the global financial crisis, between financial markets and the performance of financial markets and the performance of the economy. So the amount of money printing when central governments took over running financial markets has led to a situation where the valuations of stock markets are not reflective of economic fundamentals. And that is, you know, even more true under this COVID-19 era. We're also living through a period of some mega trends emerging, so technology being one of them. And you have seen that, you know, those mega trends in terms of, or technology mega trends in terms of the valuations of tech companies like your Amazons, your Apples, your Googles, your Facebooks, Microsofts, you know, literally taking over. And, you know, what's interesting about those companies and driving the performance of global stock markets. But what's interesting about those companies is what you don't see when you look, you know, so you actually need to look under the hood of those companies to realize that Microsoft is not Microsoft, and Amazon is not Amazon, and Apple is not Apple, the way we understand them. Those companies are massive monopolistic giants which are buying up whatever is going in the field of innovation. So whether it's healthcare provision, whether it is transport, whether it is data provision, whether it is, you know, consumer, they are buying stuff. And so they are getting bigger and more monopolistic in their behavior, which, you know, is problematic because it doesn't bode well in terms of the disruption of those companies, in terms of the global power anytime soon. So betting against SAP 500 or betting against companies, you know, in this kind of fourth industrial revolution theme is foolish from an investment perspective. So I do believe, you know, we've launched some products which talk to that theme, Signia Fourth Industrial Revolution Fund, Signia FENG Fund, which invests in the tech companies, Signia SAP 500 Index Tracker, which, you know, we offer at a management fee of 10 basis points, 0.1% per annum. I think the total expense ratio is 0.15% per annum, completely accessible to South African investors, available through JSE. You don't need to go through foreign exchange controls. That's why where my portion of my money is parked. In South Africa, then, you know, and my belief is that passive investing, low cost investing, buying the market is the right strategy, because with that dislocation between the economic fundamentals and what the markets are doing comes the fact that I think stock selection is a fool's game. You know, any asset manager sitting there saying he can choose the company that will outperform in the next year is really gambling with your money. So rather buy the market, buy the themes, buy broad themes, rather than buying into the notion that there is some genius portfolio manager that can outperform SAP 500. Not even Warren Buffett and Berkshire Hathaway has outperformed SAP 500. And then on the other side is the non-traditional asset classes, where I think you can get some exceptional returns. And that's why, you know, I am in London. We've set up a fund, Signia Oxford Sciences Innovation Fund, which just happens to invest in, you know, healthcare provision, but it invests mostly in a share of a company, which is a collaboration, so a joint venture between University of Oxford and some asset managers. Signia happens to be the largest investor in OSI. And that company basically has exclusive rights to commercializing all IP originating from Oxford University. So there are over 80 companies that have been spun out through this OSI structure. And most of those companies are involved in the provision of healthcare services. So they are spin-outs, they are startups based on the latest in life sciences, latest innovations. And, you know, in that space, I think this concept of healthcare provision at a mass scale cheaply is yet another big mega trend as far as investments are concerned, because if nothing else, the COVID-19 crisis has brought to the fore the inequalities in healthcare provision globally, not only in South Africa. In fact, you know, in South Africa, we at least have something in the public space. You know, if you look at United States, where they don't have any healthcare provision outside of private sector. So if you don't have health insurance, you know, you're on the street. You know, I think that investment in healthcare provision will be a very big trend. And again, to that topic, we recently launched Signia Health Innovation Global Equity Fund. Again, global products focusing on trends in healthcare provision. So, you know, if and then investing in South Africa, the only thing I invest in South Africa is flexible income funds and bond funds. And that is because of a high yield. But, you know, it's very kind of, you know, it's very sad to have to kind of recognize that the high yields that are on offer in South Africa are a function of the fact that our state is failing, and that in order to attract, you know, borrowings and to attract foreign investment in South Africa, we have to start paying higher and higher interest rates. And, you know, I think that trend will continue. I think we will continue. That's why I'm not that pessimistic about the rand, because, as you know, Mike kind of said, there are opportunities for the buying. And that is because of the fact that, you know, the yields globally since global financial crisis have gone negative. People are earning negative interest rates. There's a lot of money sloshing around the system as a consequence. It finds its way into emerging markets where the yields are high. Our yields will go up because of the nature of, you know, economic destruction. And hence, you know, it's still worthwhile holding a fixed interest bearing instruments in South Africa, because you can generate very healthy income. But anything else, I think, is super risky. So that's my 10 pence worth of, Magnus. I'm sure you are eager to open the floor to questions.
Well, we have a lot of questions. Thank you, Magda. It was very interesting and to the point. We have a lot of questions. We got a couple of questions on Bitcoin, which we're not going to answer, because I tend to agree with Mike that it's not an investment. I don't understand it. I don't know how it works, so I'm not going to go there. But we have one or two questions on what does a 55-year-old person do looking at RA investments, what are the options, etc. But before we get there, we don't have a lot of time. I'd just like to wrap up and summarize what we discussed today and why we had this webinar. It's not that we play a different role in the lives of our clients. We are their advisors. They pay us to make economic and financial decisions on their behalf. And coming from an industry like yourself, Magda, which is dominated by a couple of very large insurance asset managers, you know, they've had a very good run for many, many years, built up substantial assets. And the message that got through to their clients was, you don't need to invest anywhere in the world. You can get all the offshore exposure you want in South Africa. And of course, that was a kind of message that suited them and not their clients. And as a company, we started noting the divergence of investment returns roughly around about 2011, when the commodity cycle crashed, because that is one of the first signs that South Africa is in trouble. And I think Claude in his report refers to the commodity cycle as well. And from then on, we started recognizing that South Africa is not generating the kind of wealth it used to in the past, and there's no time to go through all that discussion. But yet the hostility and the invective and the criticism about our viewpoints, which we try to get across to the public, was quite astounding, where people accused you of all kinds of things, unpatriotic, and you don't know what you're talking about. But here we are, 12 years later, an investment on the JSE has not beaten inflation. 5 years later, in the last 5 years, and I look today, the JSE is exactly where it was 5 years ago. You've had no growth. You might have had a bit of dividends, but the JSE index is today where it was 5 years ago. And this has created an enormous dilemma for a lot of people who stuck to the message that stay with your investment plan and don't panic and don't be emotional. If you actually start doing the numbers, and Magda, you're the appropriate person, if your investments haven't grown by 10%, by beating inflation for 10 to 12 years, your real, the real value of your funds have declined by between 30 and 40%. So we have a generation of people retiring now with a shortfall in their retirement funding of anything between 20 and 35%. And suddenly the public is now starting to wake up to this. And that's where that question comes in from that person who's 55. I have my RAs maturing. Should I keep on putting my money in or take it out? And our view at Brenthurst has been, you take the money out, you take your tax-free portion out as soon as you can, and you reinvest it on a cheap platform like Signature, like 91, and you construct a portfolio that gives you the freedom to get better offshore returns, which we have been doing for a very long time. And then just the last final point before I wrap up, there was another question from Mr. Sali Peterson, I think, who asked, what skills do we have at Brenthurst to advise people on their offshore investments? And that's a very good question. And the answer is we have been forced to upskill our skills tremendously over the last 5 to 7 years, attending international seminars, paying for very expensive information from companies like Goldman Sachs, Fidelity, Julius Baer. We have people in London running our global funds, but yet we still know that it's a very, very big market out there, and we're upskilling our skills all the time. But we can tell our clients today proudly that we have managed to convince the bulk of our clients to externalize it between 50 and 80% of the assets. And the returns today, as an example, I saw a client, in fact, it happened to be my first ever client when I started the company. He's been with us for 25 years, and he's now turning 80, and he came and we had a chat, and I said to him, do you realize if we had not taken your money offshore, the 30-odd million rand that you have in your portfolio today would have been only 15 million rand. So we're talking about real differences by investing offshore. And lastly, before I forget, Magda, we have been investing, and like yourself, and we haven't rehearsed this, we've been trying to identify the mega trends, the global mega trends, which, by the way, South Africa is not part of, and that has been healthcare, biotechnology, technology, and things to come will be artificial intelligence and computers and so on. So regrettably, if you're looking for equity exposure, it will be on the offshore space, and in the local market, it will be in high bonds and income funds. So we're running out of time. I would like to thank Claude. I'd like to thank Mike. I'd like to thank Magda for attending. But best of all, I'd like to thank the more than 1,500 people who have been listening. We do apologize for the sound, but thank you very much for listening. It's going onto our website, and to our marketing team who put this all together, I say to them, thank you very much. It's been a great seminar. Good night to everybody.